Hi guys, welcome back. We are counting down to what has been a relatively good day actually. You might look at the headline index and think it was flat, but beneath the surface there was plenty of activity. Mayuresh Joshi of Angel Broking joins us now to talk about that. Mayuresh, hi, afternoon. I know you guys track Excite, so I wanted your thoughts. The revenues actually were below estimates at just about 9.5% in terms of growth. Would that disappoint you, or do you think that now perhaps Excite is going to turn around in terms of its earnings?
Afternoon, Sonia. No, I think it's a tad bit below expectations, but I think the larger element is something that you probably need to look forward for over the next few quarters. So the pain that you've probably seen, both in terms of raw material prices actually moving higher and the prices in terms of the average realization per battery actually staying stagnant, I think that has created an impact on an EBITDA per battery for Excite as well. The second element obviously is also the kind of expectations that one has from the industrial part of the business. So when you're probably talking about telecom and UPS, I think the strong footprint will start playing out dividends over the next few quarters. The third element obviously is the replacement market, and the replacement market should probably hold out to be pretty strong for not just Excite, for Amara Raja as well, both in terms of volume growth and the realizations thereof. What probably happens in terms of the capex that they're putting in, 700 odd crores is still expected to put in through the robotics technology, which obviously should also be some amount of a value creation project when it comes to the margin. Lead prices are actually coming off. So to that bit, again, I think it's a huge support as far as the projected EBITDA margins are concerned. And obviously the last element is going to be the overall earnings profile. So when you're probably talking about the standalone operations, add to that the value that the insurance business gives and the nominal value that the smelting business probably adds up, I think there is still sufficient value left in the stock. So there might be some amount of jitteriness from a short-term result perspective, but partly the future earnings probably are a step in the right direction in which the company is probably projecting. So anybody holding on the stock should continue.
Okay, that's on Excite. Mayuresh, hi, good afternoon. Your thoughts on ONGC? That stock is moving higher today on that CLSA report.
I'm not privy to the report, Anuj, but largely if you talk about the upstream, I think Reliance is something that we stay very, very comfortable with. I think we are holding Reliance for a pretty long length of time, and we continue to hold that in our portfolios. I think the premise here is very clear. I think when you're probably talking about how the pricing is at this point of time, and you're considering the product mix that all these upstream majors have, I think Reliance is in a far better position at this point of time, along with the middle distillate that it produces and possesses. The second element, obviously, is the new IMO regulations, which obviously are going to support Reliance from January 1st, 2020, as they start kicking in. The third element, obviously, is their core capex, which is almost over, and that incrementally also starts adding on to the overall earnings profile. The other two engines that we probably keep on speaking about, I think also de-risks the entire upstream portfolio that Reliance probably carries, in the sense that crude prices remain low. Probably the volatility plays out on the earnings sensitivity. So I think retail, the way the revenues are panning out, the EBIT margins thereof, what happens specifically on the geo front, also is a very encouraging trend and sign that we are seeing both in terms of the subscriber market share and the revenue market share that Reliance has probably garnered on the telecom business. So overall, I think if one looks at the de-risks business model, if probably one looks at the capex finally getting over, the return ratio, specifically ROE, should improve. So I think Reliance is something that we continue holding as a clear disclaimer, and that probably remains our only pick probably within the upstream players.
Okay, Mayuresh, just stay on. We'll come back to you for more. In fact, let's get in some more market opinion now. Mayuresh, any thoughts on how to approach some of these names? I mean, Jubilant Foods, after the numbers, has been only moving one way, and that's northwards. Is it still worth a buy?
So, Sonia, again, I think the numbers were better than what the street has anticipated, both in terms of the SSG growth, the operating revenues also came in higher, and the margins also were quite decent. Now, the kind of cost optimization that the management is doing and the technological innovations, I think the rental and the employee costs are probably kept in check. And the online ordering, specifically the mobile ordering, I think is moving up higher. So I think with new products coming through, the technological innovation should keep margins at elevated levels. But again, the valuations are also at elevated levels at this point of time. So yes, I think if one probably looks at a risk-reward perspective and one looks at the valuations per se, I think valuations, in my opinion, are a little bit on the higher side for comfort in terms of Jubilant Foods.
Okay, well, Mayuresh will thank you on that note and try and wrap up the day's trading.